Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Randy Frederick. He's the Vice President of Trading and Derivatives over at Charles Schwab. We're going to take a look at just how bullish or bearish traders are on the market and the economy. Randy, it's great to have you back with us. Welcome to Trade Talks. Tell us a bit about the Schwab Active Trader Pulse Report.
Well, we periodically send out surveys of some of our more active traders, which we define as people who trade 36 times a year, just to kind of get a feel for how things like macroeconomics and geopolitics and trade volumes and volatility and all those sorts of things are affecting the decisions they make and the way they're trading and investing.
So based on the results, do Schwab traders expect more market volatility, and are they generally bullish, bearish, or neutral?
Well, they are expecting more volatility, interestingly enough, in Q2 than in Q1, and that might seem a little odd for those of us that watch the VIX on a regular basis, but the reality is if you average the VIX over the entirety of Q1 and then you average it over the portion of Q2 that we've completed already, it actually has been higher. It's been about 10 points higher. About 31 was the average VIX in Q1, and it's been about 41 in Q2. Now, certainly in Q1, it was on the way up. As we know, it peaked late in Q1, and now it is on its way down. But because we're only a little past a third of the way through, it's actually been higher. So that expectation has been correct so far.
What sectors and asset classes do they think will experience the most volatility?
Well, not surprisingly, as the Fed stepped in with monetary policy to cut interest rates, financials are an area that they're expecting volatility, and of course that has been has been an underperforming sector. As most people know, financial stocks have a tendency to be very sensitive to interest rate changes, and their stock prices oftentimes are hampered when rates go down. And now that we've moved interest rates back down to zero again, that's an area. And then real estate, of course. And I think that probably harkens back a bit to what we saw back during the financial crisis, when unemployment rates go up and people start worrying about their jobs and their incomes. Then oftentimes the number of people interested in buying homes or upgrading their homes goes down, even though interest rates are lower. So it's kind of a mixed bag there, but that's definitely an area. And then of course energy, of course, everyone that makes sense too, because we were already in a slide in crude oil, and then when a lot of the travel restrictions came into play because of the virus, that put a second leg down on energy. And of course, we've seen crude oil go to a negative number, something I think many of us thought would never happen. So I would say that the survey respondents have been pretty much right on target on that particular issue.
Now, of course, the big question is the timing of the economic recovery, how long they think it will take, and does this crisis compare to others in the past?
Well, there's obviously some comparison. Certainly, there's not a perfect comparison, as we know. This is sort of what I've been calling a government-mandated recession. There are elements of three significant crashes. Certainly, some of the economic data, the unemployment rates, which we're going to get on Friday, will probably mirror levels we haven't seen since the Great Depression. We have seen some pretty substantial declines in earnings and GDP and things like that. And we've also seen some pretty sharp declines in the market. So you could probably look at the financial crisis for part of what we see going on. You could go all the way back to the Great Depression for what has also happened, and then the rapidity with which the market went from an all-time high to a bear market was actually more abrupt, but probably most similar to what we saw back in October of 1987. So if there is a previous crisis to look at, I would say it's a combination of all of the ones that most of us are familiar with.
And how confident do you think traders are in the Fed's ability to support the economy?
Well, surprisingly, the survey respondents are pretty confident that the Fed actually has the tools that it needs to continue to support this economy. It's obviously put more monetary stimulus forth than it ever has in the past, and that's actually been coupled with fiscal stimulus, which we haven't seen recently. But a large number of them actually think that the Fed does have all the tools that it needs. More than half are confident that the Fed will continue to stimulate, or maybe rescue is probably a better term, and that it has tools that it needs. So that's actually, I think, part of the confidence that we've seen in the equity markets rebounding at a faster rate than the economic data has.
Have they suggested that the coronavirus and geopolitics has impacted their trading strategy?
Well, a number of different things. I mean, some of the traders have said that it has had an impact. just under half of them said that they've been trading actually a little bit more. Now, that might also be somewhat influenced by the fact that commission prices have gone down significantly recently. And about a third of them have been trading less, and just less than, or a little bit over 17% said they're trading about the same. So it kind of depends on who you ask. I would say that one's kind of a bit of a mixed bag.
All right, and to wrap up here, do you generally agree with the sentiment in this report, or are traders maybe too bullish or bearish in your opinion?
Well, I mean, it does tend to vary each time. What we often find is that when things get a little bit more challenging, as it is right now, rather than people switching dramatically from being overly bullish to overly bearish, we find a lot more people in the neutral category. And what that generally means, I kind of read neutral as meaning I don't really know. They're not sure. And frankly, given the environment and what we're up against, the uncertainty about the virus and when it might get resolved, or when the economy will sort of come out of this, when or if we'll have treatments or a vaccine, are all levels of uncertainty that I think are higher than we've seen in the past. So frankly, that's not too surprising.
All right, Randy, appreciate the insight. Thanks for joining us as always.
You're very welcome, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.